Hello everybody. So I am behind on covering so many stocks. This is my attempt to catch up. I'm going to cover 4 stocks today: NuBank, Oddity, CleanSpark, and MARA. So let's get started with NuBank. So as you know, I own NuBank, and Latin America in general is my only outside US spot, my only OUS play, if that makes some sense. I have a small position in C Limited, but otherwise my main my view on, emerging market investing, if they can still be called like that, my view is that they're ready for prime time when it comes to Latin America. I think Latin America is ready for prime time. I think in the case of NuBank, it hasn't moved that much in a year. Why? Because it's a coiled spring that's getting more pressured, and more pressure is added to that coiled spring every quarter. And even though this stock, that was the same for Stonia, a stock I used to own back then, this stock is going to be heavily influenced also with the exchange rate of the real against the dollar. That's another factor to consider. But at some point, the coiled spring, you add pressure to it, at some point it will pop to the upside. And note that, a similar stock in this sector is SoFi. I think SoFi is a cold spring too. I think SoFi will explode to the upside at some point, because you just can't have a business who does everything right, who grows super fast quarter after quarter all the time. You can't have a business who's a winning business be ignored forever, right? At some point, there will be a pop in that stock. And of course, I'm owning it, and I'm owning it for the long run, and I'm waiting for the pop. And when the pop happens, we'll reassess as to whether that stock is still cheap or not. But for now, this is a very, very cheap stock. Okay, it's a EV over GP over RG is a 0.21. So for a stock which frankly is the highest quality neobank in Latin America, I don't think there's a number 2 player in that spot. So I find it very cheap, and the rule of 40 is 102, and that's 102 because first of all, EBITDA margin is outstanding at 38%. But when I look at the analyst numbers and when I look at the revenue growth numbers, they are really predicting that. Like, it's really, I'm putting it at 64%. It's really that much. That's what they're supposed to grow per the analyst numbers. Now, for revenue for NuBank, we need to be careful because they put a lot of that revenue aside for loan losses, provision for loan losses. But you get to find out whether you put these provisions for good reason or not. You get to find that out way later on, right? So you get to find out if the loan is repaid in like year 5 or something like that. So this makes these type of companies a little more complicated to analyze. But when I analyze these companies, I remove the provisions for losses and I add them back to the revenue. So that's why you'll see sometimes people just use $5 billion in revenue for this company. Not me. I'm going to use $9 billion. And of course, this is, accounting standards, accounting dogma. It's you as an investor, you have to decide how you want to assess it. And that's how I assess it. But yeah, you have to decide. I deal with my losses at the end of the income statement, at the bottom line, right? I don't deal with my losses at the top line. But anyways, that's just me. And of course, it's always important to reinterpret the financial numbers for you. But just like I don't use P ratio, I use this ratio, EV over GP over RG. Anyways, I ramble. I find this stock cheap. The underlying business is solid, is strong. It will pop at some point. The time is not here yet, but make no mistake, the quarter was great, and it just keeps piling and piling, great quarter after great quarter after great quarter for NuBank, so I'm happy to own it. Another stock, and this is really part of my trifecta, I guess, on the woman consumer play. And Oddity and Elf, of course, they're both consumer play, but Oddity is specific because it's only direct to consumer, right? Elf still has a lot of business in retail, right? They still sell a lot of product, but they sell a lot of products online too, but they sell a lot of retail. Oddity is like a pure DTC play, as pure of a DTC play as it gets. So these are my women consumer plays. Women oftentimes tend to not be cheap on this type of product, and that's great for your margins. That's because it's for makeup, 73% gross margin, EBITDA margin is 18%, and keep in mind that EBITDA margin is because they're investing a lot in marketing, right? And that delta here between the gross margin and the EBITDA margin, it will be all about the marketing. It's all about the debate, right? Is marketing an investment or is marketing a cost? If you're trying to sell a Lexus or a roof of solar panels or a house, marketing is a cost, and we should use EBITDA margin. But when you're trying to sell a makeup, is marketing really a cost, or are you building a brand with recurring revenue, with people who are going to stick with you for the long run? And my view on this is marketing is actually an investment. It's not a cost. So for this, we probably can't use EBITDA margin. We should probably move a little higher in the income statement, if that makes some point. Because if you know anything about this business, Il Makiage, it's using AI to make a custom foundation. The foundation is the thing that women use to like make the skin look, flat or the same color or whatever. And it solves a problem because old legacy makeup brands would use numbers, and the numbers turns out, and they would put a number near to a foundation, and you would know your number, and you would walk into the store and oh, this is my number. Well, Il Makiage does it differently. It uses AI to match the foundation to your unique skin color. So this is all about personalization. And my only experience with this is trying to color match a paint. Have you ever tried to color match a paint for you're repainting a room or something? It's literally impossible to do. So makeup is the same thing, and Il Makiage has found a secret sauce to make it great. So that's why once the woman has found the foundation that she likes, once the consumer likes the product, they're likely to come back. So it's exhibiting criteria, it's exhibiting recurring revenue criteria. Odd is exhibiting recurring revenue criteria very similar to HIMS, maybe not as high as HIMS, because HIMS is like 90% recurring revenue, but from what I understand, it's a good 60% recurring revenue of a product, and once the customer finds the product, sticks to the product, she's likely to renew the product. Anyways, this company is mixing both EBITDA margin and growth, and they have this 2020 plan, 20% EBITDA margin, 20% growth, revenue growth for the company, and they've been sticking to a plan and been doing well, and it's all about that balance between profitability and revenue. I think it's a good balance. I would like them to see them focus more on growth than they are focusing on profitability right now, because I don't care about profitability right now. I don't need fiat. I want the company to be a leader in its space, and then we'll figure out whether we want to stack fiat or something else in the future. Anyways, we're not in the business of treasuries here. Oddity, of course, is in a high growth business, and they're building new business, and so their goal over the long run is to have $4 billion brand. Il Makiage, they think, will be $1 billion brand, i.e. $1 billion in revenue by 2028. History with this company suggests that they'll get there sooner. Spoiled Child, which is their one of their skin product line. I don't really know what it is. I need to look more into Spoiled Child, but same, it's customization at the heart of the model. They're hoping 200 million this year, and they're also hoping eventually it will be $1 billion brand. And then we have Brand 3 and Brand 4, and they think these brands could be $1 billion brands. We know what Brand 3 is going to be. Brand 3 is going to be, and this is going to talk to my HIMS people, it's going to be a telehealth platform that is scheduled for a soft launch in Q3, and the platform will offer medical-grade skin and body care. So that's going to be a dermatology health platform, which I think is going to be very interesting. Actually, for Patreon, I covered a stock not too long ago, Crystal Pharmaceuticals, where they're working with mRNA technology in order to develop creams for Jeune Therapeutics, with creams dropping skin firming genes into your skin cells and having really, really good results. So there's going to be a lot of that in skincare. I actually think Brand 4 could also be anti-aging. This could be related to anti-aging. skincare, lots of revolutions happening into this space. You may know that I kind of follow the space because of BioStem. BioStem is an example of skincare, right? You're using placenta to deal with wounds, and crystal, of course. Oh, and I have InMode as well, but I haven't covered InMode in a while because their growth has stalled, so I'm out of that one. Anyways, moving on. Okay, so that was for Oddity. Elf has not reported yet, so Elf, we'll see. I'm very curious to see what's going on with Elf. The problem is that Elf has been a battleground stocks because of the tariffs. That's been the problem. But the tariffs, contrary to what you would hear in April that crashed the market, the tariffs are not forever. The tariffs are a temporary thing. And so when you want to hold a business for the long run, it's a buying opportunity in my view, because even if you think that no, the tariffs are not forever, they're a negotiation thing. But even if you think that they're serious about 100% tariff being forever, which we know it's not because we're back to 30%. But even if you're serious to that, you're not looking forward because there's the midterms, right? So the midterms, if you have the midterm and then you have election cycles, etc. So it's all a temporary thing in my view. It's not a permanent thing. If you have a 10-year horizon, really, what politicians do don't matter too much if you have a 10-year horizon. Focus on the fundamentals of the business. Moving on to entirely unrelated stocks to these two. And of course, you may say, who am I on this channel? I cover crypto, I cover Bitcoin stocks, Treasury stocks, and then I cover women's beauty, and then I cover a bank in Brazil. Well, I only care about alpha, right? That's all I care about. I don't mind if the stock is going to be operating as a pure fiat derivative if we're growing that fiat faster than the debasement, if that makes some sense. Like I don't mind that. So let's talk about CleanSpark. Let's talk about the miners now. So the miners, if you follow them, are still down quite a bit. If you look at the performance of both MARA and CleanSpark, it's uncanny how the performance has been similar. So the miners are hybrid plays, but the miners that I follow are the miners that are gonna hodl. If they don't hodl, I'm very wary of that miner, and I don't like that business. I want a miner who hodls. To me, I look at miners as Bitcoin treasury companies, or companies with Bitcoin treasuries, rather, even though they are not pure Bitcoin treasury companies. But the goal of these miners, for me, is that they can accumulate more Bitcoin, for me, right? That's why I would invest in an operating business built on top of Bitcoin. And when you look at CleanSpark, well, they've been doing okay, but they've been doing just okay compared to companies that are pure play BTC treasury companies, and they're doing just okay because of these physical operations, which I think slows them down. This is something that I'm thinking more and more about. So they produced in Q2, they produced 1,957 Bitcoin. And that's a BTC yield quarter to date of plus 19 or plus 8, roughly, plus 18 to 19% quarter to date BTC yield. So they've increased their Bitcoin stack by about 18 or 19% in one quarter. And in exchange for that, you had some dilution, which I'm fine with, but a lot of people are upset. Now you're going to have some selling of the Bitcoin to fund that growth in the Bitcoin. And you've had a lot of physical operations, a lot of physical costs. Of course, CleanSpark is famous for the backlash that it had about its private jet, because it operates in a lot of small communities. So it is a growth company. But the question is, how much are they going to grow the Bitcoin bag? So right now they have 12,100 Bitcoin. By how much are they going to grow that Bitcoin bag now, especially as they're going to sell Bitcoin in order to finance their operations, some of the Bitcoin that they mine. So you can see in March they mined 700 Bitcoin. So if we're gonna be mining, because we're going to be selling some of those Bitcoins, right? So how many Bitcoins are we going to stack each month going forward? Is it going to be 300 Bitcoins? Right? That would be about right. 300 Bitcoins going forward. So you're going to have a company that only stacks 3,000 Bitcoin over the next 12 months, and they have 12,000 right now. So 3,000 over 12,000. Well, that's not enough, right? That's not enough. What are you? Are you in 30%? Year-over-year growth in your total BTC stack? That is absolutely not enough. MicroStrategy is going to do much more than that. And so of course, CleanSpark has a lot of physical engineers, but I have a feeling, MicroStrategy is a bet on financial engineers, and financial engineers are better at growing the Bitcoin stack by just capturing the price difference between the trading price and the NAV price. And if I'm being a little more provocative, the stock I followed yesterday, which I really want to buy if only my broker would speed things up. It's Metaplanet, right? If you look at Metaplanet, to tell you, they achieved 95% Bitcoin yield, right? And they achieved quarter to date, right? This second quarter, 38% Bitcoin yield, and they're targeting, they're guiding for 35% Bitcoin yield each quarter. Right, and so CleanSpark, now I'm looking at a stock which in the best scenario is going to do 30% growth in the BTC bag, and you have stocks that are guiding you that they're going to grow their own BTC bag by 35%. And why is and look at the long-term guidance too. They guided for Metaplanet, they guided 2026, they guided 21,000 Bitcoin. And they have a history of sandbagging, so they might achieve that in early 26 and not in late 26. And so this is where it gets problematic for CleanSpark, in my view, which is they trade at a 2.09x market cap over Bitcoin NAV, right? Metaplanet, for example, is trading at a 2.7. So the delta is not enough to justify the difference in BTC bag growth, right? If Metaplanet was still trading at a 9 on a price to NAV basis, right? That would be fair. That would be fair. But right now, you have CleanSpark, who's trading at a 2.09x bit market cap over NAV, 2.09x for CleanSpark, which is likely going to grow its bag of Bitcoin slower than MicroStrategy, slower than Metaplanet, and perhaps slower than a lot of BTC Treasury companies. So, in other words, your big bet, if you're into CleanSpark, well, there's a lot of people who are into CleanSpark because they want to see it get back to where it was, and then they want to exit. That's point number one. Point number two is if you're into CleanSpark, your big bet is going to be the physical engineers. Like, you're betting on these engineers to do a great job on operations, on running the miners. That's the bet on the physical engineers. And it's a bet on the management team, right? It's a bet on the engineers, and you gotta have a lot of faith. And it's also a bet on the value of these physical assets, the value of these assets where you have access to electricity. Why does the AI HPC narrative have been so strong with miners? It's because to value them, you're gonna need to start putting in AI HPC narrative into the valuation to justify them trading at high price to NAVs compared to their ability to grow the Bitcoin bag. And I think a lot of market participants are catching on to that. And CleanSpark, unfortunately, it's not a good thing to be at a 2.09x. This is not a good thing if you're not ATMing. I wish they ATM'd, right? I wish they did dilution. But most people still don't get how dilution works. So anyways, that's okay. That's okay. Don't get or don't agree, right? Some people don't agree. I'm fine with people not agreeing. So let's talk about a Bitcoin miner, which frankly I like more than CleanSpark, and it is MARA. And why do I like MARA more than CleanSpark? Because MARA is not trading at an insane premium. MARA is a 1.1x. So it means that all of MARA's operations, all of MARA's access to power, access to electricity, the management team, the networking of the management team, all of that stuff, you get it for free if there's a little wind blowing on BTC. Just give BTC a little 10% wind, like a slow month. Give it just a little wind, just a little price appreciation, and then with MARA you get everything for free. Because MARA now, my view is much more attractive than buying Bitcoin outright or buying Bitcoin in a Bitcoin ETF, in my view, because you're barely paying an extra 10% for a company which, by the way, is mining to this day. So Q1, they mined 2,286. So let's assume they do that for 4 quarters. That means they're going to have about 9,000 more Bitcoins that they're going to be adding to the balance sheet. So they're still growing. They're going to grow their Bitcoin bag by a little under 20% over the next 12 months, roughly, maybe a little less than that. So they're going to grow the Bitcoin bag maybe 50% less fast than CleanSpark will. But how much cheaper are you than CleanSpark? You're about twice as cheap. You're just trading for the Bitcoin, right? And they are beginning to have energy assets which are not free, right? Energy assets, their grand plan is to produce their own energy, right? You can see 1.1 gigawatt capacity with up to 1.7 gigawatt capacity. Look at IREN. IREN, of course, has more gigawatt capacity, but you can see that gigawatt capacity alone, with no Bitcoin hodling on the balance sheet, can sustain valuations. And MARA is not getting credit for their energy generation for portfolio. They're not getting credit for their owned facilities, and they're not getting credit for their miner fleet. That I understand, because the miner fleet of MARA is pretty old and is not as efficient as the rest of the miners out there. So I get that. And in a quick note, by the way, the strategy of MARA, as far as the mining operation strategies go of MARA, is, they want to show, more or less, that's the way I talk about it. They want to show that really the 36-month depreciation schedule on a miner is false, and that you can probably extend the life of miners maybe to 6 or 7 years. And so how do you become profitable with old miners, less efficient miners that have been depreciated for a long time? Well, you do that by having free electricity or nearly free electricity. This is why they've bought a wind farm that is poorly connected to the grid, because I've listened to the calls where they talk some of their facilities they can get it down to 1 cent a kilowatt hour. Think about that, 1 cent a kilowatt hour. We pay much more at the house. At my house, it's like 13 cents a kilowatt hour that I pay in Texas. So, anyways. They do gas flares too, right? Gas flares, and this is the Cathie Wood big deal that she loves about Bitcoin miners is being able to monetize energy that's not out there. They do heat, they recycle heat for low grade applications. But I think what's even going for MARA even more is that if you look at their Bitcoin here, you can see that right around there we had a huge spike in the Bitcoin. And why did we have such a huge spike in the Bitcoin on the balance sheet? Is because they followed one time, for not long, but for just a teeny tiny while, they followed the Michael Saylor strategy. They issued a convertible bond. And thanks to that issuance of a convertible bond, they were able to grow their bag tremendously, right? Now, I don't know how the market looks for them, but I know that I have in front of me a CEO who's done an accretive convertible bond once. And I think MARA's CEO, if they had another opportunity, keep in mind, you gotta have demand for these convertible bonds, but if they had an opportunity to do another convertible bond, they would do it, is what I think. They would do it. CleanSpark, I'm not so sure they would. Right? CleanSpark, I'm not so sure they would, because they decided to stop dilution when you're actually trading at 2x NAV. So I'm like, I would rather see CleanSpark say, oh, we're diluting and we're buying Bitcoin. That I would love much better. For MARA, because it trades so cheap, I don't require any such thing. For MARA, all I require for owning MARA is just a little wind blowing on the price of Bitcoin for it to essentially trade at a 1x. But I also have the optionality of a CEO who actually would perhaps be okay doing a convertible again, which would be great for accumulating the stack. So anyways, this is kind of my take on these two. I hope this gives you an idea of how I feel about this. This was not investment advice, not financial advice. This is only entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.